Positive or profitable as the market moves lower. As the market turns around, if those same positions were still held, their open profits would be eroding, and at some point, at this point right here, they would be at a losing position. Our understanding is if there's a short position, or traders that are bearish on the marketplace, if they have positioned a profitable trade here and moved lower, their stop loss order would be resting right above this high, or generally many times just right at that high. The market tends to find an interest in going back to where that large body of interest, or what we call liquidity in the marketplace, it would be buy liquidities. As the market finds these lows down here, as the market rallies away, our understanding is that there's going to be buyers that have positions that are net positive or profitable as it trades higher. At some point, when the market starts to trade back down lower, back into the area in which the buy orders would have originated from, their open profits would be eroding until eventually, moving into this area here, they would be at a net loss position. So when we look at price, the idea is we're not looking for specific patterns for the sake of patterns. We're looking at where existing orders would reside. So essentially what you do is you're targeting areas at which the market has already seen a willingness to go higher or lower. In this case, we see a swing high and the market moves lower. We view that as a smart money trader or as a market maker perspective. We know that there's going to be buy stop or buy liquidity above that high. When we look at the lows, when the market moves away from these lows, we see that as sell liquidity. Identifying both of these positions on both sides of the marketplace, we're going to teach a concept called open float. While that's not going to be covered in this specific tutorial or this month of training, it's important you understand that the beginning foundations to understanding liquidity as it relates to buying and selling in the marketplace. Our first fundamental understanding is that there's going to be liquidity above old highs and below old lows. When we understand that, we can see that they will eventually target these same levels, moving price just above a previous high, knocking out the liquidity that would be resting just above those highs in the form of buy stops. Below old lows, the market will seek liquidity for the sell side or the sell stops, taking those orders out. Understanding this premise, when we view price action,
principles, and we're going to be dealing with them in general terms, and then what we do in or concept and how they influence the general populace or the speculative uninformed money. Each month you'll get 8 individual teaching tutorials that will complement the general theme for the month. This particular teaching is going to be elements to a trade setup, and as you probably noticed this month so far, we've been focusing primarily on showing the consistency that's able to be delivered to you as a developing trader after you've submitted the time and you've done the work with the exercises and the content materials that we're going to be presenting to you. When we refer to elements to a trade setup, there's really just 2 primary concerns, and one is obviously context or framework surrounding the idea. In other words, what makes the idea favorable for a trade. It's not just simply, well, my indicator tells me this or my support resistance level tells me that. There has to be something that builds a reason to want to do this trade. In my material, I'm going to be learning 4 specific principles, and we're going to be dealing with them in general terms, and then what we do in those conditions. What are we specifically pairing up with in terms of the ICT tools? The first one is going to be expansion. Okay, we're going to talk about expansion and what we look for in that condition. We're going to be talking about retracements and what tool or concept we used for retracements, reversal, and lastly consolidation. Now each one of these 4 give a specific framework and a context to the marketplace that you're going to be trading in. They can only be one of these 4 conditions. Either the market's going to be expanding, running away, in other words, trending, a retracement or pullback, altogether reversal, and obviously when the market's doing nothing, it's consolidating. But really, we all learned in the Market Maker series that there's really no such thing as the market doing nothing in consolidation. It's actually accumulating orders. Now the other characteristic we use for defining elements to a trade setup is using these 4 criteria for context and framework to specific reference points in institutional order flow. The first one is order blocks. The second one is fair value gaps and liquidity voids, liquidity pools and stop runs, and lastly equilibrium. Now, understanding those two characteristics together will give you a greater understanding of market efficiency paradigm, how the smart money interprets price, and how they influence the general populace or the speculative uninformed money. It's going to be a rather illuminating tutorial, actually. You're going to be able to look at the marketplace with an expectation of knowing what tool to apply based on what the market's providing you right now. It only takes a second or two to look at the marketplace, determine, okay, what characteristic are we trading in? So that way you can build a context or framework on how you're going to approach the marketplace. Sometimes you'll have right away an issue where you can say, I'm not going to do anything because the market's consolidating. I am going to be waiting. The other three conditions are going to be providing you an opportunity to take action relative to the tools that we couple with those conditions or context. Now, the interbank price delivery algorithm, or what I always refer to as the algo or interbank algo, is the actual, basically artificial intelligence. It's a price engine that when we receive our price for our currencies, it's actually 90% done by electronic algorithms. So it's all computer based now. It used to be open outcry in the pits, but there's no longer an auction market. It's all AI, and it's based on the principles I've been teaching for about 7 years now. You're not going to learn these things because, number one, no one's going to believe that it exists. There is this movement away from human involvement with market making. It's become much more efficient to be electronically based, and these things are programmed by human beings, obviously, and those intelligence are limited. So while that is probably unsettling for some of you that are listening to this thinking, well, I thought I had a free market I was trading in, it's actually not. It's highly manipulated, especially in the foreign exchange, which is what we're primarily dealing with here, because of the nature of it being so manipulated. The fingerprints, if you will, are easy to see once you understand the operations and the conditions that the market maker interbank price delivery algorithm functions. So when the market does what it's doing, it gives you indications, it gives you fingerprints or clues as to what you should be expecting next. And that's where your anticipatory skills are going to be coming in. You're not going to know these things right away the first time watching this video. It may go over your head. But for some of you that have already went through the prerequisites, I believe, that are in my free tutorial section on my website, if you haven't gone through the Sniper series, Precision Trading Concepts, and the Market Maker series yet, you're going to need those. Okay, so don't be discouraged if you hear some terms in here that go over your head, because they're all taught in those 3 tutorial series for free. It's a lot of material over there, so dig into not only the stuff you're getting in this curriculum with the mentorship, but fill in the space when I'm not giving you content with the free tutorials. Those 3 tutorials, and again, I'll say what they are. They are Market Maker series, Precision Trading Concepts, and the Sniper series. Okay, the interbank algo. Okay, obviously, there's going to be times when the market goes sideways or it's in a consolidation, or what I refer to as a holding pattern. Now, when this happens, the market will be looking to do an expansion. Okay, so all markets start from a consolidation and move into an expansion. That means there's an impulse move or an impulse price swing. After that impulse swing, okay, either it goes back to a consolidation again, or it goes to a retracement. When the retracement happens, it goes back down into another level of expansion. Or after the expansion, it can go to a reversal pattern. After the reversal pattern, it'll see another retracement, then back to potentially a consolidation. These 4 conditions, they interchange throughout the ups and downs and ebbs and flow of the marketplace. You're only going to get one of these 4 conditions. Now, you're probably saying, okay, well, that's a lot. I need to know one of these things to make a trade. No, you just need to know where it's at right now where it's likely to go, and where it came from. And over the course of the month of September, you're going to get a lot of understanding about how to know where the market's going to go next. And that's going to fill in a lot of the gaps that you've had with teaching directional bias ICT. The main thing is the consolidation begins with everything. All the moves that take place in the marketplace start from a measure of consolidation, because that's where the markets are building orders. So the market maker keeps the market in a tight range or a defined range until there's enough money on both sides of the upper and lower end of the range that's being defined by the consolidation. Whichever one has the highest amount of money to be absorbed, that's the direction it's going to move in. We don't always know what that is, but we wait for the expansion. When the expansion occurs, that's when we get the clue as to what the market is most likely going to be doing. And then we wait for either a retracement or another consolidation or a reversal. But we always wait for the first expansion. That gives us all the insight that we need to make a decision. Now, sometimes it may expand so far that we can't do anything with it. We have to wait for the retracement or the next consolidation. There's nothing wrong with that. It's all normal. You're not going to catch every move. The main thing is understanding these four individual characteristics to a trade setup, because price is delivered by one of these four conditions. It can't be any other way. Now, what is expansion? Now, expansion is when price moves quickly from a level of equilibrium. Now, expansion couples directly with the tool of an order block. Now, what's the importance of knowing expansion? Well, when price moves away from the equilibrium price point, and then all we have to do is go back to the down candle right before that up move. That down candle or black candle I'm drawing a small little segment off of, that's the bullish order block. When the price comes back down into that and hits it, that's where we would be buying. And then obviously you can see it hits that level and expands to the upside over 100 pips just by using that simple principle. It repeats itself all the time. It's in price action all the time. And if you study just to the left of the consolidation we have shaded in blue, there's actually a consolidation in the sell side where the market broke down and came right back to the equilibrium price point again and then sold off. I'll leave that for your study now, but we're going to move over to the next characteristic of a trade setup. The next one is a retracement. Now, what is a retracement? Retracement is when price moves back inside the recently created price range. Now, years ago, I think it was in 2012, I did a webinar called Trading Inside the Range, and a lot of folks that were following me on one of the forums that is pretty popular on the internet, they went head over heels when they learned this simple principle of understanding how you can trade inside of a range, and it doesn't even have to break out, it doesn't have to trend. You can define the range by a high and a low and trade inside that range. And that was the beginning basis point of how I brought a lot of people from that forum into the understanding of an order block. The order block was introduced in the Sniper series tutorial on my website, but prior to that I just gave indications and clues about what an order block was without actually really referring to or spelling it out for everyone. What's the importance of the retracement? Well, when price returns inside a recent price range, this indicates a willingness on the part of the market makers to reprice to levels not efficiently traded for fair value. When we're thinking retracement, the go-to is for ICT tools, we're looking for liquidity gaps and liquidity voids. When we look for price, when we see run-ups real quick and run-downs in price, in other words, real quick rallies up or real quick rallies down in price, many times that range that's created will want to come back in and close that in. And I'll give you an example of what that looks like now. Okay, this is an example of a retracement. As you can see here, the orange shaded area, we had a real quick sudden movement away from a price level, and that quick sudden movement creates what we call as a liquidity void. In other words, as the market drops aggressively like that, there's going to be pockets where the price wasn't actually delivered on every available price level at that in that range. It moved too quickly, it skipped, or it created gaps. Well, what we'll do is we'll wait as a trader. We won't chase price. We'll wait and say, okay, well, there's going to be either an indication to get long and try to fill in that range, or we can wait for it to come all the way back up to it and fill in the liquidity void. Once it hits it, then it'll probably resume going lower. And that's what we're looking for in terms of a liquidity void. So we've covered 3 conditions. The next one is the reversal. The reversal is when price moves the opposite direction the current direction has taken in. So if we are looking for reversals, we're directly coupling that with an ICT tool of liquidity pools. Now, what's the importance of it? When the price reverses direction, it indicates the market makers have ran a level of stops and a significant move should unfold in the new direction. What do we look for in price? The liquidity pools just above an old high and just below an old low. Okay, and we're looking at examples of reversals here. Every X indicates where stops would be, and the market goes just above those levels and it rejects and goes the other way, or it goes just below those levels where there's an X and rejects and goes the other way. Look how many times there's so many opportunities just on this one chart, and it's on a pair I don't really like to trade, the US versus the Swissy. This pair is real choppy. It tends to have a lot of this type of price action, so it has a characteristic that is very favorable if you're into type of trading like this. Turtle soups and false breaks are really good in the Swissy. And lastly, we have consolidation. And when we're referring to consolidation, we're directly relating that to an ICT tool of equilibrium. What is consolidation? Consolidation is when price moves inside a clear trading range and shows no willingness to move significantly higher or lower. Now, what's the importance? When price consolidates, it indicates the market makers are allowing orders to build on both sides of the market. Expect a new expansion near term. Now, what do we look for in price? We're waiting for the impulse move or impulse swing in price away from the equilibrium price level that is found exactly in the halfway point of the consolidation range. And I'll show you an example of what that looks like. Here we see where we've identified a range defined specifically by the bodies of the candles, not the wicks. As you can see, price moves out in an expansive manner and then comes right back down to the equilibrium price point and then expands to the outside. By having an understanding of these specific characteristics and elements of trading, a setup, you'll give yourself framework to first learn how to practice and study price action, and eventually work towards understanding consistent setup discovery. And by utilizing the time with me on a daily basis, we'll be able to frame these characteristics and pull out specific elements to a trade setup by repetition and by using the daily time with me, where we can outline the elements of a trade setup, we'll be able to do all these things in a manner where you'll be able to retain it, make it yours. You'll be able to discover really what type of trader you're going to be, because one of these characteristics is going to be your bread and butter condition. Some of you will trust the equilibrium. Some of you will trust the order block. Some of you will look for the void or the liquidity gaps to trade into. Some of you will have one or two of these characteristics and you'll trade within those parameters. They'll frame your trades. Some of you will eventually grow into understanding all of them and be universal, but don't think that you have to have all of them well known and under your belt before you're actually consistent, because you can just find one element, as we described here. If we just find one for you, just for you, one, you can start being consistently profitable in your trading. It only takes one setup. You know what context or framework you're going to trade in, couple that with an ICT tool, and then wait for those conditions. You're not going to get a trade every single day, but you can get a couple of them every single week. If you look at 4 major pairs with one condition or criteria, you'll find a trade every single day. But that's not what you're trying to do right now. You're going to grow into that over time. But for now, just go through your charts and try to look at all the examples that's already happened in the left side of your chart and outline them individually based on the characteristics and elements that we've identified here in this teaching. Until next time, I wish you good luck and good trading. Okay, folks, we are in the second teaching of a series of 8 for the month of September 2016. And you've seen this before, but I just want to bring this up to you one more time. This is the market efficiency paradigm. And what this generally is depicting, or what I was trying to communicate by drawing it out, is we as new traders are collectively part of this larger whole over here of uninformed money. And whether we acknowledge it or whether we believe it or what, we will invariably come in contact with the understanding that there is a smart money group of traders out there. And when I first got involved in trading, I didn't know anything about smart money. I just knew that the markets were potentially there and I could be profitable. And in fact, I was going to be profitable. I knew it. I couldn't believe that I'd ever lose money until I lost it. So when we as traders look at the marketplace as new investors, new traders, new speculators, we may or may not have the understanding that there is a smart money entity out there. And we as the larger populace of retail-minded trading, we think because of our sheer vastness, okay, we are the driver, okay, of this apparatus that's called the marketplace. And we tend to think of ourselves as the drive axle of what makes the markets go up and down, which is that's the facade of supply and demand. That's the facade of trend lines driving price when it touches it. That's the facade of moving average crossovers causing prices to go up or down. That's the facade that's perpetuated, and we are led to believe that that's exactly what takes place, either in books or in seminars or in webinars or gurus, people. And I've done this when I was younger too. I was convinced that indicators drew price up and down, and I packed houses on America Online when I got on a chat room, and people were in there flocking to hear the things that I would discuss about stochastic and RSI and Williams percent R. And I was talking about 3 momentum indicators. If you're just going to follow momentum, just follow one. So if anyone knows more about being in this group over here, trust me, it's me. I've been in this group enough to know that I learned more about this group over here that doesn't like to draw too much attention to itself. But contrast that with everybody in the retail. We all have Twitter accounts. We all have MyFX books that we're sharing. We're all trying to be on Instagram showing Lamborghinis and whatever else. Houses, cars, boats, yachts, girlfriends, they ain't even yours. Everybody is living large over here in the uninformed money. And smart money's over here quietly just doing their thing. Who's inside this small circle over here? The banks. Who's in here? Everybody on social media. Everybody in a retail account. All the gurus and teachers out there that have things that they're selling, services. And yes, I have a new service, but what I'm teaching you ain't available anywhere else. See, this group, this large populace of people, they think, and I was part of this group initially, they think that the sheer vastness and size of them is much more controlling in terms of where price is going to be driven higher or lower because of the buying and selling pressure that's equated to their mere involvement in price. And that's a facade. This huge populace of trading people or traders, community in the retail realm is really not that big. But we are led to believe that we are huge. And we are given this idea of ourselves that we're giants. We push price around. And we don't. We don't. In fact, it's this small little group of traders, okay, they're the ones that influence this entire mechanism that we call the markets. This small little group of traders is actually the drive shaft. And if this was a belt, like on a car, okay, like an alternator, this is the actual motor spinning the whole price higher or lower. It's not this big circle of people. So there has to be a paradigm shift. See, if you're over here thinking that it's the group of traders that is online talking amongst themselves as a whole, they are the ones that make price go up and down because of their buying and selling interest. Because the supply and demand factors around them, that's what pushes price around. That's a facade. And I'm here to tell you that you need to put that to bed now, because I'm going to level everything you've ever imagined about the marketplace and how it really works. You have no idea where we're going. And you need to leave this realm and this circle of people and their thought processes and transition and have a paradigm shift in your thought process about how the markets are efficient. Because they're not efficient for the speculators. They're efficient for the smart money. The banks drive price. Whether you want to accept it or not, that's what's going on. And the sooner you get to that understanding and expectation of what it is that's going on in price, it's not for your well-being, it's for the bank's well-being. It's their business. They are the liquidity provider. Everyone else is liquidity. Are you a lamb or a lion? Which one? Because one of us is going to eat meat and the other one's going to stand there looking stupid eating grass. I don't want to be a part of this herd. I didn't want to be a part of it once I understood where I was. I wanted to get out of there, and I wanted to live over here in this small little area. And for years, I quietly made money doing nothing but focusing on the things I knew that this small group of entity of traders did. And I looked at these individuals initially with disdain, thinking, I'm going to come after you, I'm going to devour you, I'm going to do the same thing. And then as I looked at it more and more and heard stories about people and their lives, losing their homes, marriages, it tugged on me, and I didn't want to just be over here being like the banks. And then I bridged over into what you saw me do in 2010, and I revealed a lot of things. In this mentorship, you're going to learn a whole lot, but it's not meant for you to share it on your YouTube channel. It's not meant for you to share it on your blog. It's not meant for you to pass it around on Twitter, Instagram, make torrents. It's not supposed to be there. It's only supposed to be between you and I. You're welcome to share this with this information with your children and your family members. Start a legacy, but don't make this common knowledge. It's going to happen. Some goober is going to take this stuff and be the one that, I'm the cool guy. I'm the one that got in there and made it all accessible to everyone else. She can feel like the hero. that you're not really doing yourself a favor. Let this stuff stay well hidden. You're paying for it. Appreciate it for what it is, and don't share it. It's not going mainstream. This is the group that we have. Whoever can make it in between October 1st and now, that's it. That's it. Because when we leave September and October, we're buttoning up all of the free tutorial stuff, and we're going right into the nuts and bolts of where we got to go to get to the latter months. See, when we come into the marketplace, we don't understand this. We think that this group that we're part of, we are the market. We are the market. We're the traders. We push price up and down. But if you were honest with yourself, if you've traded at any time and you look back on your trading, you probably looked at the market and you saw something like this. You knew something was going on, and you just couldn't put it together. You see these vague things that take place in the marketplace. Your stop gets run. It looked exactly like it was going to go up, but it came all the way down, knocked you out, and then went up. You see these things happening to you. You just can't figure it out. You know there's something to it. You've had the sensation that, this is rigged. My broker's out to get me. It's not really your broker. It's the interbank feed that drives price against the funds. And the brokers are going to expand the spread as well on you and knock you out. When you look at the price action as a new trader, and you didn't have this exposure to understanding how the markets are being driven and manipulated to the degree of every single minute detail, they're absolutely controlled. It's an AI. It's artificial intelligence, and you are not trading against a person anymore. It's a computer program that delivers price, and it knows human behavior because it's the same way it's been always. Fear and greed. So when you look at price, and you've been trading for a while, and you had this fuzzy picture about something going on behind the scenes, but never really understanding what it was until you met me. And then suddenly there's clarity. Suddenly you understand that there's something that's been there all along. Now you can identify it. And what's more important is you understand how to track it and do the same thing it does. And by default, you become a resident of that small circle, because this small circle is the drive shaft. Which makes the markets go around. It's not the big populace of traders. It's the liquidity provider. So you need to be thinking like this small group is over here. They're not trying to draw attention to themselves. They're not trying to be online flashing this and flashing that. They're just quietly in here skinning people alive. And you've been there before, and just as well as I have. You either stay in this business long enough to leave this group and come over here, or sit back in the middle here. You get real close to being there, and you get bounced back to this group. Get real close to getting over here, and then you start developing a little bit more, and you play tug of war. Some of you in my group right now, in this mentorship, you're in this little area right here, where you can see there's some signals and signs of a real entity of smart money in play, but you're not fully convinced to leave this group yet. You have too many convictions about your tools, your indicators, your pet guru, your buddy that has a website that's so cool to you. It's just not enough. You got to be able to release all that stuff and just leave it all behind and join the smart money. Because, trust me, we're not serving cookies, but it's a way better lifestyle over here than it is over there. Now, in the first video, I gave you elements to a trade setup, and I gave you two characteristics to it. There's context and framework around the trade, and then obviously those refer back to institutional order flow. So you have to be able to bridge the two, understanding expansion, retracement, reversal, and consolidation, and applying them to respectively order blocks, fair value gaps, liquidity voids, liquidity pools, stop runs, and equilibrium. What does that mean for us, for instance, in its scope of price? How can we use these ideas and make them applicable to price? Now, I know some of you are chomping at the bit to learn long-term trading because you can't do day trading, but bear with us as we go through these first couple months, because I want to give you immediate feedback. And the way you get that is by using intraday study, because you get a lot of feedback in intraday action that is applicable to longer term charts. But I can't teach long-term long-term trading on daily chart inside of 12 months adequately. It can't be done because you're only looking at a scope of 1 year. But with intraday, it's like compressing years of data in just 30, what's it? Not even 365 days really. 200 some days that we're going to be together. So let's look at the daily range. Suddenly expansion, retracement, reversal, and consolidation mean something. Every day starts with consolidation, Asian range. After midnight, there's a manipulation that takes place. That's expansion. It's coming in the form of a Judas swing. What is it doing? It's making the higher low in London. That's the London swing. For a reversal, that's a run on stops. Then there is another expansion move. Okay, down into the New York session. Then there's going to be what? Another consolidation. That's the New York consolidation going into the 8 to 8:30 news embargo lift, where there's going to be another injection of liquidity or a reversal. Then there'll be another expansion, and then we go into London close, which is another reversal condition. And then what happens? The market goes in consolidation for the rest of the day. So we have a way of looking at these things and applying these concepts to time of the day and repeating characteristics. Now let's get back to the interbank price delivery algorithm. The daily range structure can be really broken down and simplified with, it starts with a price equilibrium. That's Asian range. Then there's a manipulation. And that's always going to come by way of some news event, some news driver, either at the time of the manipulation or just before it. That's the Judas swing. Then we'll see a range expansion. In other words, after the higher low is formed, the range will start expanding. It'll go down into 5 o'clock in the morning New York time, or go up into that time window, depending upon the daily direction. We're going to use the perspective that it's a buy day. That means that the Asian range had a small consolidation, and then right after midnight in New York time, there's a drop down in price. That's the manipulation, making the false move for the low. There's a range expansion, then it goes into the reversal. That's classic London open scenario, where it shoots down, runs the stops, and then what happens? It expands again. There's another range expansion into what? 5 o'clock in the morning. New York time. Between 5 o'clock in the morning to 8 o'clock in the morning, in that time window, the market will go back into consolidation. Then it'll have a retracement between 8 o'clock and 8:30 in the morning, New York time. Then it'll have either a reversal in New York session or another expansion move. The range will expand and make the rest of the day, going up into 10 o'clock or 11 o'clock in the morning, New York time, where it will have a reversal again. That's London close. Then the market will go into consolidation, ending true day at 1900 on Forex Ltd's platform. If you follow along with the videos we've been doing so far this month, you'll know exactly what I'm talking about. So we can see the interbank price delivery algorithm on a daily basis by studying these events and then seeing it over a period of time. You'll know what is most likely to happen. Now let's look at it a little bit further. If we're looking at price delivery, and this is the model that comes by way of my understanding of how the interbank feeds price to everyone. If we're focusing on delivery of price, we have to understand that it all starts with a consolidation. Nothing can happen until consolidation. Consolidation is when the market's quiet. Why? Why is that important? Because that's when the orders are building up in the marketplace. The market makers will allow orders to build up above and below the range. The next stage is always expansion. It's not consolidation to retracement. It can't retrace. It hasn't moved anywhere. It can't go consolidation reversal because it has to come out of the consolidation. So when you see a consolidation or holding pattern, you got to think the next leg is going to be in price. It's going to be an explosive move or an impulse leg. Impulse price swing. Movement. You need to see movement. By determining what that movement is and what direction it is relative to the conditions you're trading in, Once we're in the expansion stage, okay, then you have a choice. It can retrace, come back to the order block it just left behind, and then recapitalize that and then make another leg up or down relative to the direction it's moved. Or once it's moved into expansion, it can reverse. Once it reverses, okay, there'll be another expansion, and then it goes back to a consolidation. The main thing is I want you to understand is it never goes consolidation retracement. It never does consolidation reversal. It's always consolidation expansion, and then from expansion it goes either retracement or reversal. It does not do consolidation, expansion, consolidation. That does not happen. It does a consolidation, expansion, either retraces for another move into an order block and then recapitalize it and do the same direction it moved when it made it expansion, or it goes from expansion to reversal. When you understand this algorithm, the way it moves and the way it operates, it's very generic, it's very systematic. It has only a few options to go to, and they're time sensitive, they're day sensitive, okay? They're intermarket related. So when one market is moving real fast, if you understand the relationships like I'm going to teach you over a couple months, you'll know where the trade's setting up, because one's being held and the other one's letting it run, which is the importance of knowing what the euro pound's doing if we're trading fiber or cable. All these things are going to blend together, and you'll know exactly how I'm doing these things internally. And I'm doing it on the fly. I'm not measuring things and writing this down, writing that down, making notes over here. I just know by looking at price what I should be seeing. And you see it. I'm thinking out loud in the videos when I'm doing the live sessions with you. All aiming at your better understanding of price delivery. And when you understand these things, when you get to the level of month 8 and month 9 in the mentorship, you're going to be so strong at knowing what the next thing's going to happen in your price that you're studying. You'll know all these 4 things, okay? There's only certain processes that have to take place in a certain order. Like I said, it never goes consolidation reversal. It never does consolidation and retracement. It goes consolidation to an expansion move. There's an impulse leg, up or down. It's either going to retrace back down into where it just rallied up from, or it's going to rally back up into where it just dropped down from. The consolidation starts it all. They're going to run an expansion, and then once it expands, it's either going to come back and retrace and give another leg up or down, or it's going to reverse. And then from the reversal, start applying time. The general structure is consolidation in Asia, expansion, reverse in London, make the higher low of the day, then expand. Small consolidation in New York, retrace between 8 o'clock and 8:30 in the morning New York time, another expansion move, reverse, back to consolidation. You understand price delivery then. You will not learn it just by what I just explained to you just there. But you'll use this as a model that repeats itself over and over and over again. When you have higher time frame directional premise understood, and then you look at this price delivery algo, it's so easy to know what the price is going to do. Every single day since the last week of August, we've been together. And every single day I've given you something that went right to the pip or had an explosive direction move where you could have taken 50 to 60 pips out. And I don't trade that much every day. But I'm showing you, by desensitizing you to fear and greed, there's no need for those things. What we're teaching is consistency, the ability to see these things happening all the time, and also exercising willpower on not wanting to make money. So you're suppressing the desire to make money, you're developing your patience, and you're learning a great deal. You have no understanding of how much you're learning just in these first 2 videos, but I'm telling you, you'll be able to look back on this months from now and say, man, that was a huge step I didn't appreciate until now. There's a certain process, the way the price is delivered, and it can't be changed. It won't be changed. And don't be afraid because you're learning it. 700 people is not going to turn the whole world around, okay, and they stop doing this. It's not. So, again, in closing, take the information I'm giving you, stuff it under your mattress, stick it in a love letter to your grandkids on how to do it, but don't market it. Don't do that. Okay, not because I'm going to lose sales. It's just it's too good to share, and you're going to see why I've kept it for so long and not wanted to do it. And hopefully you guys will take this information and do something really great with it, and that means not starting a website selling it. Okay. There's nothing more I can say about this video except for there is a process that you're going to learn that is very generic, and it will not break. It will not stop working. And when you look at the marketplace in your charts, I want you to think. Now, it doesn't matter what time frame you're looking at. I'm just using the daily range to give you how easy it is to see on a repeating format. So simple. Every day you get an opportunity to study and see how it works. That same thing happens with a weekly range. The weekly range is the same thing. Sunday's open, consolidation. Then there's an expansion move in Monday. Then what? There's a reversal on Tuesday or Monday. And then what? There's another expansion move. Then it goes back into consolidation midweek. And then it's either going to do what? It's going to reverse or it's going to retrace. It's never doing consolidation retracement. It's never doing consolidation reversal. It's consolidation, expansion. Then from expansion, you're making a choice. It's either going to retrace back or it's going to reverse. Trust me, it seems like you still have a lot of choices to make, but it's not. And when you understand what you're looking at in terms of price, you'll know if it's really leading to a reversal or if it's really going to retrace and give you another opportunity to get in that another leg up or down that you saw in the first impulsive move. And believe me, you'll need to go back to this video, even though it's the second one. You'll come back to this video as we give more details along the lines of price delivery over the next couple months. Month 4 and 5, you'll still refer back to this one, and you'll see there it is. It's been there all along. So with that, guys, I'm going to wish you good luck and good trading.
Okay, folks, welcome back. This is the third teaching of a series of 8 for the first month of the ICT mentorship. Okay, we're going to be continuing on our theme of understanding the mindset that you have to have going into the marketplace, looking at things in a little bit reverse order than you're normally taught from a retail perspective. And this is one of those teachings that you're going to have that if you're new, you actually have the advantage here. For folks that have been trading for a while, that have adopted bad habits or an understanding or a belief that they have an understanding, it's going to be a little bit expensive for them because they're going to have to purge some of the things that they either subscribe to or wrestle with it until they either do or elect not to use this insight at all. I mapped out a crude depiction here, and I've been using it for months actually as a teaching tool. But we're going to really hammer it down in this mentorship because it's imperative that you know how we as traders are supposed to be viewing marketplace data delivery, reverse psychology, whatever the psychology of this informed money is. It's going to be diametrically opposed to that of the uninformed or speculative money or quote unquote dumb money. And when we have these ideas, when we look at price, okay, the first thing we have to do is establish who is the victim here. You know, generally there's a victim always in every crime. And the perspective that the speculative uninformed money has is that, number one, they don't acknowledge that there's a smart money. There is not an entity out there that has, quote unquote, the right things always on, the right perspective, or that a market is rigged or controlled or manipulated or has any influence over long-term price delivery. The uninformed money okay, or those that are uninformed in regards to how smart money actually operates and exists in the marketplace, their actual perspective really is that indicators are the answer. And uninformed money, their perspective holds the belief that price moves by indicators' influence. Okay, and the influence of an indicator being overbought or oversold, that is what the precursor is to a market moving higher or lower. And I can tell you, I subscribed to that for years as a new trader, and it took a long time for me to actually be broken away from that type of mindset. So if you're new and you haven't been exposed to indicator-itis and you're not infected with that yet, you're actually pretty good in terms of advantage. Those that like to use indicators are going to have a little bit of a struggle with this mentorship, because I'm telling you, basically, you need to get that out of your system, get that off your charts, because it is not how you're going to be able to see smart money. In fact, we're going to be able to use these indicators to be informed as to what the uninformed traders are actually thinking. So when we talk about sentiment next month, you'll have a lot more understanding about what that is, how it's developed, and what you can do with it. Now, obviously, we only exposed one side of the paradigm here by specifically dealing with the speculative uninformed money's perspective. You're not here to really so much learn about those individuals, because obviously we all know that there's a losing crowd in the marketplace, and your idea of being a part of that group is foolish. So we're here only to focus on what the smart money view is on the marketplace. And that begins by understanding that there is a huge, vast, enormous new pool of liquidity coming into the marketplace every single day. Even though there's new busted accounts all the time, the statistics tell us that 90% of traders lose their money. Large funds are in the same category. Not every fund is profitable. Just because there's a lot of people that are investing money into this fund or this fund manager does not in no way guarantee that that fund will exist a year, 2 years, 5 years from now. So we, as informed traders, our perspective is to hold the perspective of what a liquidity provider or smart money view is on the marketplace. And they put a spotlight on the aspects of uninformed money, because that's what makes the world go around in the marketplace. The smart money is there to provide liquidity, but they're doing it at a exchange premium. In other words, they're putting in trades that they're going to most likely come back to either offset or neutralize for their interests. And we're going to talk more about that as we go. But for now, understand that the smart money knows, in fact, that there is a large body of uninformed money out there. Contrast that with what we spoke of concerning the uninformed money's perspective, is there's a lack of an entity out there that has a smart money perspective on the price. They don't have an opinion or an idea-based perspective that there is someone or some entity or entities out there that have a smart money perspective, or that the banks would actually trade against large firms or funds. That goes against the grain of what a free market is. So when we have a smart money perspective in the marketplace, we actually use their perspective as everybody else's liquidity. And price is delivered to engineer efficiency for the smart money entities only. It's not anything outside that. So to hold the perspective of a liquidity provider, you are adopting a smart money perspective, and everybody else is liquidity. And the liquidity is going to be in the form of buy stops, sell stops, pending orders above and below the market highs that are most recently formed on your charts. Once we understand that there's two distinct perspectives, that's what creates the market efficiency paradigm. Both groups, okay, have their individual perspectives. The one that is smart money, they have the unique perspective of understanding already what the uninformed money is going to believe about the marketplace, and that gives them their edge. On top of that, they're actually in control of price. Just like anything else, if you own a storefront or if you own a business and your commodity is sold, who sets the price for that commodity? You're the store owner. Well, currency is owned by the bank, and they set the price on the value of that bank note or that digit on your screen that says you have XYZ number of dollars in, or francs or pounds or whatever it is that you're measuring your currency in. that value is set by the central bank that has printed that money. And why this is such a speed bump for people's understanding is beyond me, because if you look at the state of the world we're in right now, obviously corruption and deceit is the name of the game. So it's not a shock to hear, if you first time being exposed to this, that the central banks are in absolute control of what their price of their currency is, and they can set it at any time at any price they want. Don't believe me? Look at what they did with the Swiss franc and the euro when it was depegged. Instantaneous wipeout. Okay. So once we understand both perspectives, okay, intimately, okay, we no longer have a at odds perspective on the marketplace. We don't vilify the market maker. We don't vilify smart money. We don't beat up or make fun of the uninformed money. In fact, what we do is we find a balance in between that. And we don't think in terms of victim or aggressor. We just think in terms of efficiency, because the markets are always going to trade in an efficient manner, but it's slanted and more prone to lace the pockets of the smart money, because they have the advantage of pricing wherever they want price to go to, and they already know what the perspective is of the uninformed money, and they also know how to manipulate that perspective at any given time based on chart patterns, based on indicators, based on just reactions to the market news. Now, as we go through this mentorship, we're going to be focusing primarily on your understanding of these four primary drivers in price delivery. It's retracement, expansion, reversal, and consolidation. Now, we're not going to talk specifically about that, but I want you to understand that all the things we're teaching here, they're all frameworks for you to understand those four general principles. We can't teach specific contexts or topics without having a broad-based understanding and foundation, and that's what this entire month of September is doing. It brings everybody to a reference point to start at the same location. Some of you that are advanced, that watch a lot of my free tutorials over the years, you need to put that aside for a moment and start with this perspective in mind, and I promise you it's going to deliver everything that you've skipped over. We're going to fill in all those gaps. But understanding that the interbank price delivery algorithm, okay, to understand that, it's going to have to come by exposure, and exposure creates experience. That experience is going to give you the understanding of going into the charts, seeing what they should be doing at price, what you should be seeing in price, by seeing each individual component explained in detail and context. Each individual part or component of the whole will be able to dovetail nicely, and you'll understand how everything fits together. But suppress that desire to feel like you have to have techniques and patterns and intricate secrets about how the chart does this or chart does that. You have to have the framework in mind and the foundation of why these things exist. Otherwise, all those little things ain't going to make any sense to you when I'm calling on you to refer to them. So with all that, what specifically should you be focusing on right now? As a new student in this mentorship, the first thing you need to know is there are very little things you should be bringing into your expectations and what your understanding should be. In other words, basically what I'm saying is you need to have no previous knowledge brought in with this. Kind of like put everything aside and assume, and it's very difficult for those that have already gone through different disciplines of trading, because they have to try to forget what they already know. And even if they've made money with it, which is the worst thing that could have ever happened, is if anything outside of institutional order flow led to your profitability, it really was just coincidence, and coincidence can happen for a long time. I did it for 9 months and it was all pure luck, and then it no longer worked again. So understanding right now what it is specifically you're supposed to be doing, that's important as a new mentor student. The first thing you need to be doing is creating a daily price action log with price charts. Now, I know some of you don't want to do this. Some of you have resisted me telling you for years to do this, but I'm telling you, you all are here and you've paid for this mentorship. You paid for the understanding and experience that I've gained over the last 23 plus years. I can tell you how I got it was doing the very things I'm going to tell you to do in this specific video. It starts here. If you skip this video, if you skip what I'm teaching you in this video, if you ignore what I'm telling you what to do in regards to what specific things you should start with right now, it does not mean okay, just because you've been trading longer than anybody else, and because you have understanding what optimal trade entry is, because you understand what an order block bullish and bearish is, because you understand what a liquidity void is, that is not an advantage. Okay, you need to go back to square one and understand that this is strength in your development. If you don't do these types of things, you're actually going to hurt your development, and you're going to hurt and stunt your growth throughout this mentorship. So go back to square one. You're the new student. Do everything that's being described here and advise, because this is where the money starts coming in. If you have these things in place and you start right at this very core principle, it will develop. We're going to be focusing on this throughout the entire 12 months. Every month, we're going to build on what rules and what things that you're supposed to be looking for in the charts. But for right now, primarily, the only thing I want you to be doing is starting with a daily chart. Okay, your daily chart needs to show 12 months, no less than 9 months view. You have to have that much perspective on your chart. Don't have so much of a perspective you have multiple years on your chart. 12 months to 9 months ideally. Okay, you need to have a 4-hour chart, and your 4-hour chart needs to have 3 months of price action viewed. The 60-minute chart or 1-hour chart has to have at least 3 weeks view. And the 15-minute chart needs to have at least 3 to 4 days view. That means for every chart here, I'm recommending a specific amount of data that needs to be displayed for that respective time frame. What you need to resist doing right now is you need to resist the urge to forecast price movements. That's not for your stage of development right now. Do not try to rush ahead and try to figure out what the market's going to do next, because that's going to be a problem for you, and it's only going to lead to frustration. We will get you there, and it's going to happen in due time. But for now, resist that urge. But there are some things you need to be specifically doing with these charts. You need to note where price shown a quick movement from a specific level. In other words, if it's run quickly higher or lower from a particular level, that's noteworthy. You need to note that on your chart. You need to also note recent highs and lows that haven't been retested. That means if a high's formed on your chart, if the price has not come back up to that level in recent time, okay, you need to make a special note of that, because it's going to probably be influential going in the future. Vice versa, just contrarily speaking, you're going to be able to look for the lows that have formed that have not been recently traded to. And that low will be influential later on in future price delivery as well. Note areas on the charts where price has left clean highs and clean lows. Basically, that looks like two equal highs that formed in close proximity to one another. Whenever we see a high go up and form, and then it trades away from that for a little while, and then comes right back to it and doesn't make a new high, or maybe it falls just a little bit short, just a little bit above it, I note that as a clean high. And usually buy stops will form above that, and the market will usually come back up there and run through that. It doesn't mean it won't continue through it, but it's usually a big bullseye for price to want to go up into that area. And the reverse is said for double bottoms or equal lows. When a low is formed and another low is equally formed in close proximity to the initial one, that's a big area for sell stops to pull or build up underneath those lows. And the market tends to have a willingness to go down there and test that liquidity. That means the market will go down into that area, whether it continues to go lower or if it goes down there and then reverses. There's conditions that we look for to frame all that, and you will know when to expect the specific conditions. But for now, I want you to start practicing looking for that in your charts and having them noted on your chart. Note what days the highs and the lows form, and this is for the weekly range, and you want to note what time of day that occurs, what kill zone. Is it the high and low of the week forming in London, or is it forming in New York? Because all those things are going to lend well to prognostication and what should happen going forward. And you want to note the daily high and the daily low every single trading day. And you want to note when the daily high and the daily low forms for every individual trading day. Now, what does that look like? Well, it starts off with a bare bones chart. This is a daily chart, and I'm using the Swiss franc here. It could be any chart, any pair, but you want to start with one currency pair and then some mentorship. You want to specifically deal with one. I would recommend you doing something apart from the British pound and the euro, only because you're going to see me specifically dealing with that in this individual mentorship. But you want to be doing something with a currency pair that is not being utilized in this mentorship. So that way you're getting a unique perspective that you yourself have arrived at using this as a guideline. But the first thing you want to do is obviously note the most recent highs and the recent lows where markets have shown a willingness to repel from. That's the first thing you want to note, because this is how you identify order blocks. This is how you identify liquidity voids. This is all the beginning frameworks of that. But you need to be able to note those recent highs and recent lows. That's what's been done for you here. Next, you're going to drop down into a 4-hour chart. And those same levels I just noted on the daily chart are shown here. And there's more highs and more lows that come into visibility by doing a lower time frame perspective. We went from, again, the chart was a daily chart before. Now we're looking at those same levels. Just drop down into a 4-hour chart, and those levels will be transposed immediately to what the 4-hour chart shows. Then you go through doing the same thing. You're looking for areas where it's too clean, equal highs and equal lows in close proximity to one another. And you'll look for where the market has moved quickly away from a particular level. When it creates these real big candles or bars, okay, on your chart, you want to note that, because they're going to be influential in your expectations of where price should go and where they should not go. Then you're going to go down to an hourly chart. Okay, in an hourly chart, you're going to be looking at individual days, okay, over a course of 1 or 2 weeks. And you can get the weekly range defined with the hourly chart, and you can look at the intraday highs and lows with an hourly chart. Hourly chart's a really good bellwether chart if you're a short-term trader or a day trader. That's like the daily chart for the barometer, whether you should be a buyer or seller. And we'll teach all those things, all those intricate details will be taught in this mentorship. For now, you're going to be taking all those levels you found on the daily chart and the 4-hour and transposing those to an hourly chart. Now, you want to keep this chart, okay, in this format, separate from all the other charts that I'm going to talk about now. Okay, anything else we talk about in terms of what we're specifically looking for, they don't get utilized on the same chart. You create another chart. So you're going to have 2 individual, independent US Swissy charts. Okay, but you're going to carry the information on 2 separate charts. That way you don't have charts that are too busy, have too many things on there, and you get confused and all kinds of things that we're worrying about. Then you'll create another Swiss franc chart, okay, and for that you're going to use a 15-minute chart, and when it's loaded, obviously it's going to be naked, bare, nothing on there, and the 15-minute chart looks like a lot of noise. It doesn't give you any perspective without any frames of reference, and you want to take the course of action we talked about using the daily, the 4-hour, and 1-hour chart, and do that same thing with the individual 15-minute chart, but you only need to be applying it to the last 3 days, 3 to 4 days. And using those reference points on the last 3 to 4 days on a 15-minute chart, okay, you're going to be looking at also the daily highs and the daily lows. And you can see this is how I do my charts on a 15-minute basis. You're actually going to see me actually do this very practice every single day going forward, starting with this week that we're going to enter into in the mentorship. I note the previous day's highs and the previous day's lows, and then draw them out to where 0 GMT is, which is 8 o'clock in the evening time in my time frame. And in this delivery of data with this platform, this is how I note my daily highs and daily lows. It's important to note also the days of the week. Now, I'm not going to give you all the specifics here because you're actually going to be watching me do it on a day-to-day basis. So you'll be able to get a rough idea in this tutorial, but more specifically, you're going to actually see me actually creating documents for my individual record keeping. So you're going to see actually how I do my charts, how I log them. And yes, even after 23 years of trading, I still do this. It's important to do it. It's understanding, it's clarity, it gives you perspective, and it's what professionals do. Sorry, it's just, there's no way around it. The folks that are really concerned about the market, they have logs, they keep journals. These are the types of things that they do. If you notice real quick, why noting the previous day's highs and previous day's lows? If you look at Wednesday's data, okay, you see the little delineation where it says Wednesday. If you look at the previous day, obviously it would be Tuesday in the course of a normal week. The high that was formed on Tuesday, on Wednesday, the price came right up there and ran through that around the 97.90 level. Notice it did not continue through that. It just went up through the previous day's or Tuesday's high. Then it sold off. When it sold off, it went all the way down. Where did it go down to? Just any old level. It went down to Tuesday's low, just breaching it by a pip or two, and then came back off into consolidation. Then look at what happened on Thursday. Thursday, we had price retrace back into the range that was created from Wednesday's high down into Wednesday's low. Thursday starts today with trading in a consolidation. It rallies up, closes in a range, okay, that was formed from Wednesday's high and Wednesday's low. Then it sells off, and where does it sell off to? Moving just below. Then it pulls off that low and goes into consolidation. Then we have Friday. The market just goes straight on up, rolls right on through Thursday's high, and creating a new high. Prior to Friday, the weekly high was formed on Wednesday. It ran out the stops and all the liquidity that would be resting above Wednesday's high, all done on Friday. So we're going to be using these reference points and giving you a lot more insight about specifics and what you're doing with it. But for now, I want you to know that this is what you're going to be doing going forward. Every single trading day, you're going to document price action, and you're going to build on your understanding. Every month, I give you more reference points to add to your charts and why it's important, what the information will do for you, what advantages it gives to you by having it. And by having your charts very uniformly organized like this, when you're trading, your chart is going to have its independent analysis. You're not going to have all these things on your chart, but these charts are always going to be referred to while you're watching price, because by having 3 charts, okay, because you're going to have one that's executable, in other words, what you're watching on the setup right now, because you never want to marry the ideas that you have in your analysis. You need to reflect on them, but you don't want to be so cast iron and can't do it any other way. It has to be that way. Otherwise, if you're watching real-time price action, if you see something that doesn't make sense for what the underlying conditions that you're expecting occurs in the marketplace, you won't have the flexibility to switch gears or go to the sidelines. You'll just hold on to the market with strong conviction, and that's imposing your will, that the market's going to do what they're going to do, and it's not going to happen because you want it to happen. It's going to happen because it's going to happen, and we try to get in sync with what the market's going to do, whether it's going to be moving sideways, whether it's going to go higher, whether it's going to lower. We don't know any of those directions with a great deal of certainty. We just know probabilities. But we know how to go into the marketplace looking for these types of things over and over and over again. They repeat, and you'll be able to find those repeating occurrences in price action after going through this mentorship. Welcome back, folks. This is the 4th of 8 installments for the first month of the ICT mentorship. We are covering equilibrium versus discount. Now, again, just as a forewarning, for some of you were actually pupils of mine prior to me starting this mentorship. This is going to seem a little bit elementary initially, but I promise I'll add something to it that may bring a little bit more depth to the understanding of what optimal trade entry is. A long time ago, back in 2010, I introduced a simple idea of looking at swing projections, retracements, and identifying what would be deemed as optimal trade entry. And everyone, that saw it obviously fell in love with it, liked it. It was easy for them to see. They would apply it really quick to the chart. And I think the reason why is because it had a indicator applied to it, and that being the Fibonacci. Now, Fibonacci doesn't have any magic, doesn't have any significance by itself. You have to understand where the market may want to reach for. So there's going to be a certain measure of prognostication on your part. The Fib doesn't do everything for you. So I want to draw your attention to looking at where markets are most likely to create buy conditions. Now, this is not buy signal entries. This is just framing a context initially as a new trader, someone new to technical analysis, someone new to my principles. It's going to give you a foundation so that way you can go into the charts and start looking at these things and measure them and then study them. Okay, so all this is meant is to give you a framework to work within in your demo account. Everyone should be working inside the Forex Ltd demo account, as I established at the beginning of this mentorship. So we have multiple price swings in here. on this daily chart, and we're looking at primarily a daily chart initially for our setups. If you're a new trader, okay, and you just seemed overwhelmed, you probably heard me talk about certain things already in this mentorship, or maybe you've watched some of my videos on YouTube or on my website's tutorial section, and you heard terms that went right over your head. Some of the terms are created by me. Some of them are industry standards. Some are going to require a little bit more description about what they mean later on in the mentorship. So if you hear something even in this presentation, just make a note of it in your notes, and then obviously you'll pick up the understanding as we go deeper. Every month there's something new. But for now, I want you to focus on a simple question. If a trader believes that the market's going to go higher, what would frame that context? What would give the trader that conclusion to trust buying a specific market? Like what goes into making that decision? Well, the first thing I want you to understand is this is going to be like the very first baby step to understanding institutional order flow. The first thing you need is movement. You have to understand that to be a buyer, there has to be a willingness of somebody with bigger pockets than you, more money than you, and they are the ones that move price around, and they are the banks. Okay, they're only going to let price go higher when it suits their purpose. Okay, so it's not going to be a supply and demand factor. It's going to be a greed factor. They want money. Okay, they're in the business of making money. After all, that's their nature of their business. That's a bank. So if we are looking for buying opportunities, okay, many retail traders look for all of these patterns and indicator-based ideas, and I want you to focus primarily on price. Price alone will give you everything you'll ever need in terms of indicating higher or lower price, and it'll actually give you the actual specific entries and your exits. You don't need anything else outside of a price chart. Okay, the open, high, low, and close does everything for you. I want you to look at this low down here, and I want you to look at this high up here. Okay, do you see how that is the biggest price swing on this entire chart? So between August 14th all the way to the present time in September, there has only been one major price swing higher and lower. So if we take a Fibonacci level, okay, and I'm only going to use Fibonacci to illustrate equilibrium, okay, because I first have to establish what equilibrium is. This is the largest price range, okay, or the market range that's presently being traded in. Now, what do I mean by present market range? This is the highest range we've seen, okay, in the last month or so. So if we look at this range, and I'm going to scroll back here so you can see it, there's nothing more significant than that except for this one back here, but we're going to primarily use this one because it has a very strong reaction. We can use these back here, okay, and I'll do it for completeness sake later on in the video, but for now I want you to see we have a very strong impulsive move away. Then it comes back, retraces, then it have another strong impulsive move away, and comes all the way up here to the high. Okay, when we say impulsive price move, or what we refer to as impulsive price swing going forward throughout this mentorship, that is the indication that there has been displacement. Now, displacement is where someone with a lot of money, okay, comes into the marketplace and they have a strong conviction to move price higher. We already know that price is going to be set by the central bank. So if they're letting price run this high, they're offering at a higher price. As long as there's buyers coming in, they're going to keep offering that price there. As long as they keep finding buyers, as they keep raising price up, they'll keep expanding price higher, 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 until there is no longer any interest for them to pair up orders with participants. Okay, other open interest in the marketplace. So they'll allow price to retrace a little bit until they can get more buy stops above the marketplace. It is not a buyer market and they keep stretching price. They have already bought down here, and then they're allowing price to be offered to the marketplace at higher prices. Okay, and as that happens, all they're doing is selling off their positions they established at a lower low. Okay, from here, the banks are in long positions in here. They accumulate long positions. Once they accumulate a position, they allow price to go higher. Okay, once that price goes higher, 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 it keeps going higher until their position is funded and they no longer want any more position held. So they're going to be looking for liquidation areas where they know that there's going to be willing participants to buy. That's going to be above this old high back here. Why would they want to take price above that old high here? Because there's going to be buy stops on a fund level. That means big money managed funds will have stop loss orders right above that high. And I'm going to go into details in this mentorship about where stops are, how to pick out institutional funds levels where their stops are at, where high target big money moves are going to occur. All those things will be taught to you, but for now I just want to start you very small, because then there's a lot of folks that just started with this mentorship and they've never really been through the complete library of my concepts, or they haven't really exposed themselves to technical analysis. So all this seems Greek to them, and I don't mean that to offend anybody that may be Greek, but it's an expression in the States. It means it's alien to them. But the first thing I want you to look for in price is you want to see impulsive price swings. Okay, and since we're primarily looking for discount markets, okay, in relative terms to equilibrium, we first have to understand what an impulse price swing is. So let me take the fib off real quick and go back to that price leg right here. Let me take all this stuff off over here. Okay, so we have one big strong impulsive price swing right here. It comes off this low and rallies up. We don't need to know what caused the buy down here. It's not interesting at all to me. I don't care. Okay, we don't know this price link is going to start until, we don't know this price leg is here, okay, until it forms. So I'm giving you a perspective, studying in hindsight, the low to this high in here, okay, that rally up or that impulsive price swing, we only require price to start coming down off of that, and it takes at least 4 candles. No matter what time frame you're on, you need 4 candles, okay, from when the market makes a low and starts rallying up. What you're going to look for is once you see a high form, let me zoom in. Once you see a high form, you need 4 candles. Why 4 candles? You need to have 1 candle to the left, 1 candle in the center, the most highest one, then a lower candle to the right. That's a swing high, and then you got to see price go lower. When that happens, you start waiting for price to retrace back to equilibrium. Now, what is equilibrium? Equilibrium is a midway point of a price move. Okay, so we're measuring the high from this low. You take your fib, you draw it up to the low, and you drop it. Equilibrium is over here. Let me scrunch this up a little bit more. Okay, so we have this price leg up. So impulsive price swing goes higher. As soon as we get 3 candles, then and only then will we start watching for price to come down to the equilibrium price point, and that is basically the Fibonacci level 50%. Okay, we're looking for price to come down to that level, and as soon as it comes back to that level and we're on a daily chart, we go down into a lower time frame and we hunt buying opportunities. Now, I'm not teaching you buying entry signals, okay? I'm giving you context of how to discern when the market goes to discount and when it's at a premium. And we're not trading at premiums, okay? Well, I'll teach you how to use premiums the first video of next week, okay? So we're only focusing primarily on equilibrium versus discount. We have a price swing that moves from a low aggressively up. We don't do anything until we start seeing a down move, and it has to happen after 3 candles, basically making a swing high. Now, a swing high looks like this. Okay, you can see it has a high and a candle to the left that's lower and a candle to the right that's lower. That's a swing high. And then once that swing high forms, we're waiting for the 4th candle, okay, to start coming lower. In other words, we're looking for 4 candles to start turning around. When that happens, okay, it gives you, now you're allowed to start looking for the market to come down into equilibrium. That means the 50% level. Okay, once you're on a 50% level and you're in a higher time frame, and we start everything at a daily chart, At the daily chart, we know now that between the low here and the high here, the market now has gone back to equilibrium. So it's at fair value, or at fair market value. If you get something at fair market value, obviously you're not paying a premium, but you're not really getting a discount either. But it's still a neutral to bullish condition. That means you're not buying at an inflated price. So this time period right here, the market is offering an opportunity to be long. I'm not going down to lower time frames today. I'm not going to teach you that today. Only thing I'm giving you right now is developing context around the daily institutional price levels that are arrived at on the daily chart. And all you're looking for is impulsive price swings first, letting price settle back down into equilibrium, and then we discern what we're going to do when we get to that level. As you can see, without going into lower time frames, the price does rally again. Where does it rally back up to? Its old institutional order flow reference point, which is an old high back here. So it goes right above that previous high. See that? Now the market trades off again and goes lower. So we have now a new range. We have to now put the Fibonacci on this high, keeping it off the same low. Now, why did I do that? Because this price low has not been violated. It only retraced down to here. It rallied up again. Then we wait for 3 candles. The high candle to the left, there's a lower one. To the right, there's a lower one. This is probably a Sunday, and even still, this is one here. Either way, you don't want to count Sundays, by the way. MT4 on Forex LTD does give you the Sunday candle, so you got to factor that out. Don't count Sunday's candle because it's a non-event. So that's probably going to end up becoming this candle here. Once you get the down candle here that the market has in fact turned, it's starting to go lower. Notice what's happening here. We're not rushing. We don't need to catch the high. Okay, it gives us all kinds of time to wait and plan and build an idea about what it is specifically we're going to do when price gets to equilibrium. Price drops down a little bit more, then it goes up. What do we do the whole time this is happening? Nothing. We're not doing anything. This is a higher time frame principle. Most of you are all begging for a higher time frame principle to trade with. This is the beginning building blocks to that. Okay, market trades lower, lower. What do we do here? Nothing. We're not doing anything here yet. Okay, nothing. Trade lower, 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 lower. All of a sudden, boom, it hits equilibrium over here. Now we can start studying price. We want to study price. On the lower time frames, we'll look for entries, but I'm not teaching you entry signals here. I'm giving you context. As soon as we get to equilibrium, we are now at fair market value, so the market is permitted to be bought. Okay, at the banking level, they will be able to buy at these levels because they're not at a premium-based market. The levels that are trading at this level here are at fair market value. Now, banks are just like anyone else. If you go to the grocery store and you see steaks for $10 of, I don't even know what they cost because my wife does all the shopping. If a steak costs $10 at the market and it drops down to $8.50 a steak, that's probably a discount. And it may not be that price, I don't know, but for the sake of analogy, we're using it. That means that we are now at a discount. Anything below equilibrium is now a discount market. When markets go below equilibrium, they do not spend much time below equilibrium, and there's usually a very dynamic price move away from that, especially if the context behind the marketplace is bullish. Now, looking at this framework we have here, we had an impulsive price swing here, a tiny little retracement, came back to equilibrium, rallied one more time, took out the high over here, and then sold off. Okay, went back down into equilibrium again and went to a discount below 50% of the impulse price swing. That is now at a discount. So the market on the banking perspective is that this now is at a discount. It is allowed to be bought. Now, you just don't go indiscriminately in there trying to buy it just because it goes back to 50% or less. That's not enough. You got to have more information. But for now, I just want to give you when we have a bullish scenario for a marketplace. Okay, if we think a pair is bullish, we look for impulsive price swings on the daily chart to frame higher time frame ideas. There's other trades that you can take in lower time frames in between these, but for now, I want you primarily focused on just this, because it'll give you all the things that you've probably been lacking with higher time frame ideas and the beginning blocks of directional bias. Because it's daily, it gives you a lot of time too. You don't have to be sitting in front of an intraday chart. You don't have to worry about the boss catching you doing something and stealing time at the job. This gives you a lot of flexibility and time to prepare for an idea to trade on. So when we get to equilibrium, we know that we are at fair market value. It's a market that can be bought if we are bullish, but we can't buy it. We can't buy above this level up to here. Okay, that's the point of what I'm saying. The best buys come at equilibrium or less. Anything below equilibrium or the 50% level is viewed as a discount. Now, the wonderful thing about understanding this is when a market's at discount and its underlying basis is bullish, discount prices don't stay in the market very long. The market's going to want to run away from that really quick. Because this is a daily chart, this isn't that bad in terms of how much time it's spent down there below equilibrium. But you can see finally it explosively moved away from that and rallied up through what I asked you guys to do in the third tutorial, which was to, on your charts, mark out areas of where equal highs would be and where old highs would be. The market rallies from that price point and goes right back up and clears out these equal highs. When these equal highs are taken out, if you were a trader that only took a long in this area, and it don't have to be an exact science as far as where it was, we're just going to speak in general terms. If you went along somewhere in this small little consolidation before the expansion, okay, between buying at the 95 big figure roughly up to these equal highs, that's about 98.50. Yeah, about 98.50, and you bought around 95.50. So that's 300 pips move on a signal that would have formed. It took a little bit of while to come to fruition, but based on equilibrium and discounting, okay, you can frame the ideas in which the market should react. It should be viewed as a discount across the board, and if it is in fact bullish, the banks will dogpile on this and send the price higher, and it should be with quick dynamic price action. Understanding where it should be reaching for, above old highs, above equal highs, okay, above closing a range, okay, which we don't really have in here, but I'm just showing you just in one example here. Already the first one, it's 300 pips, okay. Then we have another price move all the way up here. There's no real retracements in here because watch, we have a high, equal, a little bit lower here, and then here's one here. If we would have measured the low to this high, it doesn't come down to 50%. It's nowhere near. I can eyeball that, and you can probably do that too, but I probably might. Let's just do it because I'm probably going to have some of you folks that are from different countries having a hard time understanding my English, let alone Forex. If we would have measured just this impulsive price swing right here, notice that even though we had the candle here lower on the fourth one, it had an up close, but it was still lower. Nothing came back down to equilibrium. It stayed at a high price, and it just kept going higher and higher and higher and higher and higher. So if we go back to adding the fib to that initial price low here, and we stretch it because now we broke this high. We're going to keep drawing the fib up on swings that move up dynamically. So we have this big parent price swing. So now we're going to wait until price gets back down to equilibrium. When do we start waiting for that? When the market shows a swing high, which it does here. Then we start counting to the fourth candle where it drops. So the fourth candle has to move lower or be lower than the highest candle that makes the swing high. It's all. It's a very simple thing. And then from there, we just start waiting and we count down every time it goes down to a newer low, low, lower, low, lower, low. And finally, what's it hit right here? Equilibrium. That's that 50% mark. As soon as it does that, the market is at a fair market value so that it can be bought on the banking level. It cannot be bought until it gets to that level or below. They won't come in. They won't do it. It's not based on Fibonacci. I'm just showing you in terms of equilibrium between old highs and old lows. It's just a valuation marker. That's all it is. Okay, so the algo will kick into a buy mode in here, especially if they have orders at that level or just a little bit below it. And if they are there, you'll know it because the price will react immediately like it does here. It hits it one time. It doesn't have another candle touch it. This one gets close to it, but it still rallies away. Okay, so now watch what happens. We have another impulse swing here. Price moves away from an area where we expect it to rally. Why do we expect it to rally there? Because between this low and this high, price should be sensitive here on the upside, and it rallies. Now watch what happens. This is a big, big step. I'm going to keep this Fibonacci just like it is. I'm going to add another one right on the low that starts here, and it runs up here. See that? So between this low up to this high, why are we counting this swing? Why are we using this Fibonacci price swing, Michael, and not something else? Because this one showed reaction to want to move away from an area we would expect it to move. And now watch, we have a swing high. Here's a high, lower high, and this candle is lower than the one on the highest portion of the swing high. So now we start counting down until price gets to what? Equilibrium or less. The next candle doesn't do it. This candle does. It goes right down through equilibrium down into what we call optimal trade entry. So when we get below equilibrium, all this timing here, look how much time it gives you opportunities to get in at 62 to 70.5%, which is the optimal trade entry sweet spot. If you look at that, price gathers up more orders and rallies away aggressively. Watch what happens again. Now we have another reference point. This is where we expected price to react, and it did. It gives us another price leg. We pull it all the way up here. From this low to this high, we get a high, a low, a lower low on this one, and we're already below equilibrium. Look at the buys of the candle. We wick through it. I'm not going to talk about order blocks here as much as I want to right now. It's for some of you guys that do know order blocks, you probably know what I'm talking about before I would say it. But in here, we expect price to be sensitive in here, okay, because we're below 50% or equilibrium. We're at a discount. Price should not spend much time there at all. It quickly rallies away, okay, and it comes back down. I could draw a fib on this low to this high. Matter of fact, let me just do it. After all, that's the context of what we're teaching here today, right? Pulling the fib on all these levels where there should be reaction. Okay, market rallies up. Here's the swing high. The next candle, the fourth candle's got to be lower. It does. It trades through equilibrium right into optimal trade entry. Does it stay there long? No. It rallies up, comes back. It doesn't break the high. Comes back one more time to equilibrium, and then aggressively moves away. And expands, and then finally it gives us a reversal. But nonetheless, that right there from buying in here to here, let's look at that in terms of range. $300 pips again. Okay, it's not every day setups, okay, but it's giving you significant setups. If we look at the moves that we called in here using what I'm showing you, if you bought down in here, just to this level, here's 140 pips. To here, it's 272 pips. If you held on to it, it's 400 pips. This price move in here, price should be sensitive right here. I'll throw it in here. Order blocks right here. You'll learn about those. But the Fibonacci we just showed you, it's still there. And watch this. We had a price swing here that reacted off of a level that should be bullish. Here's our new price leg here. We have a high and then a higher high. So we have a higher magnitude price swing that's going higher. We wait for the swing high to form. Down candles right here. Equilibrium's right here. Into the optimal trade entry, which is a discount. It's got to be below equilibrium. If the market is below equilibrium, we are in a discount market, and it should not go below the old low it forms. In other words, wherever the impulse price swing is, that low it starts from, it can't go below that. So think about what it's already given you. It's given you a framework to work within. Okay, I don't need to know exactly where I'm buying at. I just know a general area. I can fine tune that down into lower time frames. When we do top-down analysis, I'll teach that. But for now, if we understand this is the low we draw our fib from, that a stop loss has to be below there on this time frame. So we can buy in this area here, put a stop loss down here, define the risk between that, and then how much of a risk to reward will we get based on how far it should reach up. Every time that price makes an impulse price swing higher, we just wait for it to come back down, and there's no rush. We just wait. It takes 3 candles. On the 3rd candle, it can hit equilibrium and go below it, but we need to just simply wait for the swing high to form, and then you watch it drop down. Once it drops down, you know what you're going to be expecting. The price move should be explosive to the upside because the market goes back to a discount below equilibrium. It can be as sensitive at equilibrium, but here's what we're supposed to be focusing primarily on. You want high odds trades. You want high probability explosive price action moves in your favor. That happens when it goes below equilibrium because the market will go to a very suppressed levels. And when they go below equilibrium to a discount level, markets will not sustain discount prices very long if the underlying pinnings of the marketplace is bullish. So it gives you 2 things. It gives you a context to work within when you for buys, and it gives you also a relative strength study that's built in. It should be sensitive. It should be dynamic. Price action moves away from that equilibrium or less. More specifically, below equilibrium. So that's where the optimal trade entry idea came from when I was using the 62% to 79% retracement levels that you see on my Fibonacci's. Well, it's this over here, 62, 70.5, and 79%. Okay, and those levels are very, very sensitive, not because of Fibonacci's sake, but because it's really just measuring how far the current price range has been. The algo had a low down here and it had a high here. This is the total range that we're trading inside of. Right now, okay, this is right now current as of today, Friday's close of September 16th. Okay, so right now we are in the range that's been defined by the high and the low here. So that level of equilibrium still exists, which is here. So any buy condition that occurs below this level here is high probability. Well, what does that mean? That means you just measure every single impulsive price leg higher. When it moves up, actually, let's do this. Let's shade this area. And that way we'll understand that anything below here, that's in a high probability or discount market. Okay? So now when we understand that, we can define every single price leg that moves up, which is an impulsive price swing. When it moves higher, all we have to do is measure the new equilibrium point at which it's created. And here, I'm going to start right here. There's the impulse price leg right there. So we have the low up to the high, swing high, 4th candle's got to be down. It does. Hits equilibrium. Should it respond? Yes, it should be dynamic. Does it go higher? Yes, it does. Makes a new high. Where does it go to, Michael? Above a previous high over here, and then it trades back down. Now here we have equilibrium again. It trades to equilibrium and then aggressively trades through it. You're probably thinking, oh, it failed. It does. That's what's going to happen sometimes. You're going to lose money. I want you to understand that it's not going to be perfect, but it's going to give you more context than you have right now, especially if you're new. If you have been looking at price action before, you probably have never looked at it like this in terms of valuation between equilibrium and discount. And we're going to teach the importance of that the rest of this month in the remaining teachings. But for now, I'm going to introduce you to the idea of viewing price in this context. Below equilibrium here, no discount. We come all the way back down and take out a stop. Stop runs is what's going to be a different profile, and if you take a loss, that's what you expect. You expect this occurrence to happen, where the market takes the low out. Well, if it does take that low out, what is it probably really doing? It's taking stops out, so that it should be a turtle soup. Turtle Soup's a false breakout pattern. It went below that low. We should see a responsiveness that's aggressive that moves higher. We see that here. Okay. Market trades up, makes an impulsive price leg. From that low all the way up to here. Now watch, here's the cool part about this. We have a swing high. You have the high, the lower high, the lower high, and the fourth candle is down. Does it ever get down to equilibrium? No. So we have no trade. We don't catch anything that keeps going up. No problem. I ain't worried about it. You ain't worried about it. Next price leg we look for. Okay, we have this price leg here. We're only focusing on inside the yellow area. That's the shaded discount portion of this market. The dollar Swissy, this current market is at a discount below this line here. This is equilibrium, the top of that yellow shaded area, and below it is discount. So the market should be responsive at levels of discount after we see this high form. We look for the high, the swing high of the form, and then the fourth candle's got to show willingness to be lower. It does, and then we simply just wait. We wait until it hits the equilibrium, and then we go down to the lower time frames and we look for trading signals. There may or may not they may or may not have been one here. Okay, I'm going to say maybe you took one there, and maybe you took a loss. Great, no problem. You took a loss. Here's a losing trade here, and here's a losing trade here. No problem. We had a winner here. The market's going down into a deeper discount. Look at this swing low over here. Okay, this is the building blocks of understanding how institutional order flow will incorporate bullish order blocks. When market comes down into a discount and a deep retracement of this impulsive price swing, you're looking at the down candles right at the low.
In the world of trading, one of the most misunderstood yet powerful concepts is liquidity. To trade like institutions rather than retail traders, you must understand what liquidity is, where it is located, and how the market uses it to fuel price. Movements. Let's explore liquidity in a detailed, step-by-step way so every trader can understand how smart money sees the market. 1. What is liquidity? Liquidity is the pool of buy and sell orders waiting in the market. These are orders placed by traders at different price levels, such as stop-loss orders, buy stops, sell stops, limit orders, pending orders. But most importantly, liquidity represents where traders have placed their stop losses. Why do institutions care about that? Because large players need opposite orders to fill their huge positions. When retail traders place stop losses above highs or below lows, those stops become targets. For smart money. 2. Why does price seek liquidity? Large institutions can't enter a position at a random price. They have too much volume. They need to find an area where many retail orders are waiting. So the market moves to liquidity pools to harvest these orders. In simple terms, price moves where stop losses are. These stops provide the fuel for big players to open their positions. This is why the market often hits your stop loss before going in your expected direction. Not because it hates you, because your stop is liquidity. 3. Where is liquidity found? Liquidity lives in predictable places. Smart traders know exactly where to look. A. Equal highs and equal lows. 2 or more highs at the same level create a liquidity pool above them. These are called buy stops above equal highs, sell stops below equal lows price. Almost always returns to these levels to take that liquidity. B. Previous swing highs and swing lows, the highs and lows of as yesterday. Last week, last month, the Asian session, the London session, all contained stop losses. These are magnets for price. See trendline, liquidity, traders. Love, TRENDLI. ES. They place buy orders and stops under trendline twosers. Smart money sees this and knows. Beneath every trendline in an uptrend sits a pool of stop-loss orders. So, eventually the trendline breaks, not because the trend ended, but because the liquidity below it was needed. D imbalance and XAGUSD. Edges of fair value gaps often hold liquidity because traders put stops just outside those zones. E-order block edges, the high and low of major order blocks, contain pending liquidity. 4. Types of liquidity. Smart money concepts. Liquidity comes in several types. 1. Buy-side liquidity. This refers to buy stops, orders above price. Examples: equal highs, old highs, swing highs, Liquidity above consolidation. When price reaches buy-side liquidity, it hunts short sellers' stop losses, causing sharp upward spikes. 2. Sell-side liquidities refers to sell stops, orders below price. Examples: equal lows, swing lows, old lows. Liquidity under a range when price reaches sell-side liquidity. It hunts long traders' stop losses, causing sharp downward spikes. 3. Internal liquidity within the internal structure of a trend. Examples: a small low inside a larger uptrend, a small high inside a larger downtrend. Liquidity built up during a pullback. Internal liquidity is used to fuel the next leg of the main trend. 4. External liquidity. Margin liquidity levels outside the current range. Examples: last week's high, the previous day's low, a major breakout level the market often seeks. External liquidity before reversing sharply. 5. How smart money uses liquidity. Smart money uses liquidity in 3 ways. 1. Liquidity. Grab price intentionally. Moves to a liquidity pool, hits the stops, spikes through the level, and then reverses. This is a stop hunt or liquidity sweep. Point 2. Liquidity. Engineering the market creates equal highs or equal lows intentionally to build liquidity. After building a nice pool of stops, the market sweeps the liquidity and then moves in the real direction. This is why ranges form before big moves. 3. Liquidity transfer. Price moves from one liquidity pool to another, using retail stops as fuel. Think of it like price eating liquidity to stay alive as it travels. 6. Real examples of liquidity behavior. Example: A. Equal highs. Price forms 3 equal highs. Traders think it's resistance. They place sells. They put their stops above the highs. Price later pushes up, grabs all buy-side liquidity, and falls immediately. This is a classic liquidity sweep. Example B. Trend line 3 touches on an uptrend line. Traders by the trend line. Stops are placed below the line. Price breaks the trend line, clears the stops, then shoots upward. This is trendline liquidity in action. Example C. Asian session, range during Asian session, price consolidates. Liquidity builds above and below the range. At London Open, price sweeps one side, reverses, and runs to the opposite side. This is classic session liquidity behavior. 7. How traders use liquidity strategically. To trade using liquidity, follow these principles. Principle 1. Liquidity marks a target price, is attracted to liquidity pools like a magnet. Principle 2. Liquidity sweeps signal reversal after a sweep. Look for market structure shift FVG order block. Retest these. Give high probability entries. Principle 3. Liquidity creates the fuel for price to move far. It must collect liquidity first. Principle 4. Avoid trading directly into liquidity, ever buy at equal highs. Never sell at equal lows. 8. How to build a liquidity-based trade setup. Identify liquidity on both sides of price. Determine which side is likely to be taken first. Wait for the liquidity sweep. Look for a market structure shift. Enter using FVG order block breaker. Block place stop loss beyond the sweep. Target opposite liquidity. This method aligns you with institutional flow instead of retail. Traps. 9. Why retail traders lose? Because of liquidity. Retail traders lose money because they buy into resistance, equal highs, sell into support, equal lows, put stops in obvious places, rely on trend lines, react emotionally to breakouts, don't understand stop. Hunt smart money uses this behavior. Retail fear creates liquidity. Institutional logic consumes it. 10. Summary. To summarize, liquidity is the collection of buy and sell orders in the market. Price moves toward liquidity because institutions need those orders to fill their positions. Liquidity exists at equal highs, equal lows, trend lines, swing points, and session levels. There are buy-side liquidity pools above price and sell-side liquidity pools below price. Price often sweeps liquidity before making the real move. True smart money trading means understanding where liquidity is, how it forms, and how to use it. Fall entries after sweeps. Liquidity is not just a concept, it is the foundation of institutional price movement. In the world of trading, one of the most misunderstood yet powerful concepts is liquidity. To trade like institutions, rather than retail traders, you must understand what liquidity is, where it is located, and how the market uses it to fuel price. Movements. Let's explore liquidity in a detailed, step-by-step way so every trader can understand how smart money sees the market. 1. What is liquidity? Liquidity is the pool of buy and sell orders waiting in the market. These are orders placed by traders at different price levels, such as stop-loss orders, buy stops, sell stops, limit orders, pending orders. But most importantly, liquidity represents where traders have placed their stop losses. Why do institutions care about that? Because large players need opposite orders to fill their huge positions. When retail traders place stop losses above highs or below lows, those stops become targets. For smart money. 2. Why does price seek liquidity? Large institutions can't enter a position at a random price. They have too much volume. They need to find an area where many retail orders are waiting. So the market moves to liquidity pools to harvest these orders. In simple terms, price moves where stop losses are. These stops provide the fuel for big players to open their positions. This is why the market often hits your stop loss before going in your expected direction. Not because it hates you, because your stop is liquidity. 3. Where is liquidity found? Liquidity lives in predictable places. Smart traders know exactly where to look. A. Equal highs and equal lows. 2 or more highs at the same level create a liquidity pool above them. These are called buy stops above equal highs, sell stops below equal lows. Price almost always returns to these levels to take that liquidity. B. Previous swing highs and swing lows, the highs and lows of yesterday, last week, last month, the Asian session, the London session, all contain stop losses. These are magnets for price. See trendline, liquidity, traders. Love, TRENDLI. ES. They place buy orders and stops under trendline twosers. Smart money sees this and knows. Beneath every trend line in an uptrend sits a pool of stop-loss orders. So, eventually the trend line breaks, not because the trend ended, but because the liquidity below it was needed. D imbalance and XAGUSD. Edges of fair value gaps often hold liquidity because traders put stops just outside those zones. E-order block edges, the high and low of major order blocks, contain pending liquidity. 4. Types of liquidity. Smart money concepts. Liquidity comes in several types. 1. Buy-side liquidity. This refers to buy stops, orders above price. Examples: equal highs, old highs, swing highs, liquidity above consolidation. When price reaches buy-side liquidity, it hunts short sellers' stop losses, causing sharp upward spikes. 2. Sell-side liquidities refers to sell stops, orders below price. Examples: equal lows, swing lows, old lows, liquidity under a range when price reaches sell-side liquidity. It hunts long traders' stop losses, causing sharp downward spikes. 3. Internal liquidity within the internal structure of a trend. Examples: a small low inside a larger uptrend, a small high inside a larger downtrend. Liquidity built up during a pullback. Internal liquidity is used to fuel the next leg of the main trend. 4. External liquidity. Margin liquidity levels outside the current range. Examples: last week's high, the previous day's low, a major breakout level the market often seeks. External liquidity before reversing sharply. 5. How smart money uses liquidity. Smart money uses liquidity in 3 ways. 1. Liquidity. Grab price intentionally. Moves to a liquidity pool, hits the stops, spikes through the level, and then reverses. This is a stop hunt or liquidity sweep. Point 2. Liquidity. Engineering the market creates equal highs or equal lows intentionally to build liquidity. After building a nice pool of stops, the market sweeps the liquidity and then moves in the real direction. This is why ranges form before big moves. 3. Liquidity transfer. Price moves from one liquidity pool to another, using retail stops as fuel. Think of it like price eating liquidity to stay alive as it travels. 6. Real examples of liquidity behavior. Example: A. Equal highs. Price forms 3 equal highs. Traders think it's resistance. They place sells. They put their stops above the highs. Price later pushes up, grabs all buy-side liquidity, and falls immediately. This is a classic liquidity sweep. Example B. Trend line 3 touches on an uptrend line. Traders by the trend line. Stops are placed below the line. Price breaks the trend line, clears the stops, then shoots upward. This is trendline liquidity in action. Example C. Asian session, range during Asian session, price consolidates. Liquidity builds above and below the range. At London Open, price sweeps one side, reverses, and runs to the opposite side. This is classic session liquidity behavior. 7. How traders use liquidity strategically. To trade using liquidity, follow these principles. Principle 1. Liquidity marks a target price, is attracted to liquidity pools like a magnet. Principle 2. Liquidity sweeps signal reversal after a sweep. Look for market structure shift FVG order block. Retest these. Give high probability entries. Principle 3. Liquidity creates the fuel for price to move far. It must collect liquidity first. Principle 4. Avoid trading directly into liquidity into liquidity, ever buy at equal highs.